Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting market narratives under extreme stress. Today's subject is JOYY Incorporated, and we're putting them right on the anvil. You see, their latest earnings report just hit the street, and if you listen to management, they're painting this picture of a massive, full-blown comeback. Now, for a stock that's been beaten down and under pressure, this is a make-or-break moment. So the question for us, the real question, is simple. Are they actually forging a new weapon for growth here, or is this just shiny fool's gold designed to catch the light? We're about to find out if this company has the structural integrity to even be considered for a serious portfolio. Let's get to work. Okay, let's start right here, because this is the statement that really got our attention. The CEO, Ting Li, she comes out swinging with language like this. A pivotal moment. She highlights their first year-over-year revenue growth in what feels like a lifetime for them. Honestly, this quote is the entire bull case wrapped up in a neat little package. It is a direct declaration from the very top that the bleeding has finally stopped and the big rebuild has officially begun. Now, we all know the market absolutely loves a good turnaround story, and management is basically handing investors the first chapter on a silver platter. They're telling you, look, the old crumbling foundation has been reset and the scaffolding for brand new growth is already going up. It's a bold, it's a confident statement. It's designed to do one thing: signal strength.
Whoa, hold on a second. We're just going to take management's word for it? Just like that? A pivotal moment? Come on. Every single CEO says that after one decent quarter when their stock has been in the gutter. We're Iron Financial. We don't listen to the sales pitch. We get out the tools and we inspect the steel for ourselves. Before I get even remotely excited about one optimistic quote, I need to see if these numbers can withstand any real, actual pressure. So are we going to do our jobs here and stress test the supposed turnaround, or are we just going to sit here and read a press release to our audience?
That's exactly why you're here, and you're absolutely right. A quote is just that, a quote. It's a starting point, nothing more. So here's how we're going to break this down. This is our stress test. First, we'll examine what they're calling the turnaround signal. Second, we're going to deconstruct their revenue piece by piece. Third, we have to solve what I'm calling the profitability puzzle. Fourth, and this is crucial, we're checking the foundation, the balance sheet. And finally, we deliver the iron verdict. No more talk, let's get to it. All right, let's kick this off. Section 1, the turnaround signal. Look, every comeback story has to start somewhere. It needs a catalyst, a single event that changes the narrative. For JOYY, management is pointing their finger directly at the fourth quarter top-line revenue number. So let's isolate that number and see if this first structural beam can actually hold any weight at all. And there it is. In the fourth quarter of 2025, net revenue clocked in at $581.9 million. Now, compare that to the $549.4 million they posted in the exact same quarter last year. That is a 5.9% increase year over year. Now, a 6% pop might not sound world-shattering, but the context is everything. What's so critical about this slide is that it definitively breaks a long, painful negative trend. After quarter of decline, seeing a nearly 6% year-over-year jump is significant. This right here is the specific data point the CEO is hanging her hat on. This is her pivotal moment. And you know what? On its own, this number looks solid. It's a clear, undeniable signal of a positive shift in momentum. It's the kind of green shoot that value investors hunt for in a company that's been lost in the weeds. Okay, fine. A 6% pop in a single quarter, I see it. But any builder will tell you, you do not judge the integrity of a skyscraper by looking at one shiny new window they just installed. One quarter can be an anomaly. It can be a fluke. It can be manipulated with accounting tricks. Heck, it can be used to hide much deeper, more systemic problems. A single 3-month period proves absolutely nothing about structural integrity. So if we're really going to deconstruct this thing, we need to zoom out. I want to look for cracks in the wider structure. What does the bigger picture actually tell us? Let's see the full year performance before we even think about celebrating the so-called turnaround. And there it is, just as I suspected, the first major crack in the facade. You look at the full fiscal year of 2025, and total net revenue was $2.12 billion. Okay, but in 2024, it was $2.23 billion. That is a decline. So while they're out there popping champagne corks for a strong finish to the year, the hard reality is that the entire structure for the full year is actually smaller than the year before. So much for that pivotal moment, huh? I mean, how can you stand up and claim a turnaround when your full year revenue is still actively shrinking? To me, this looks less like a powerful rebound and more like a classic dead cat bounce at the tail end of a really bad year.
That's a completely fair point, but I'm going to argue it's a surface-level analysis. You're looking at the overall size of the building, but I'm looking at the materials it's being built with now. The full year number in this case is a lagging indicator. It's just reflecting the weakness from earlier in 2025. The real story, the one that actually points to the company's future, is hidden inside that Q4 revenue number. We have to break it apart and see what it's made of. The composition of that revenue is infinitely more important than the full-year total. Why? Because it shows a fundamental, deliberate shift in their entire business model. This isn't decay. It's a planned reconstruction.
Now look at this. This is the blueprint of the new JOYY. This is what they're building. In Q4, we have three main components. Live streaming, which is their traditional core business, is still the biggest piece at about $394 million. Then you have this small other revenue slice at $42 million. But look at that second slice. Advertising. It's coming in hot at $145 million. That's not a side project. That is a substantial piece of the pie. The real story here isn't the total revenue number. It's the powerful emergence of that advertising engine. They are actively and intentionally swapping out old, decaying materials for new, high-growth steel beams. And this slide right here just brilliantly illustrates the entire strategy. It puts their two main engines side by side, and the contrast is just stark. On the right, you have the old legacy engine, live streaming. In the fourth quarter, revenue from that segment was down 6.6% compared to the prior year. It's shrinking. Let's be blunt, it's rusting. But on the left, you have the brand new engine they are forging right now, advertising, and it grew an absolutely explosive 62.4% year over year. So you see the point. Yes, the total revenue for the full year is down, but that's because their legacy business is in a managed decline. At the exact same time, they are building a new high-growth business that is firing on all cylinders. This isn't an accident. This is a deliberate, high-stakes, and frankly, gutsy pivot.
A pivot? That looks more like a desperate gamble to me. Their biggest, most established business, the very foundation the company was built on, is shrinking by almost 7%. And we're supposed to get excited because a smaller, newer business is growing fast off of what was a much lower base? That's like telling me you're tearing down the ground floor of your house, but it's okay because you're building a really nice fancy shed in the backyard. Can you really build a skyscraper on a foundation that is actively shrinking? That new advertising engine has to do some incredibly heavy lifting just to offset the decay in their core business. I'm just not convinced that's a stable plan.
And that is the central risk. You've hit it right on the head, and we are going to get to it. But you can't just look at revenue in a vacuum. A company's true strength is also measured by its ability to generate actual profit. And this is where the turnaround story gets even more dramatic. If the revenue growth was a signal flare, then the shift in profitability is a full-blown earthquake. We have to look at the bottom line now because this is where JOYY literally went from being in a deep, dark hole to standing in broad daylight, all in the space of 12 months. Just look at this number. Let's rewind the clock to the end of 2024. The company posts a net loss of $304.1 million. I'm just going to pause there for a second. That is a staggering amount of red ink. A number like that suggests a company in very serious trouble, hemorrhaging cash with absolutely no end in sight. This is the picture of a weak, unstable structure that had investors running for the hills, and you know what? For good reason. So just remember that number, over $300 million in the red. Okay, now fast forward just one single year to the quarter they just reported. Net income of $54.3 million. I mean, let that sink in for a moment. They went from a $304 million loss to a $54 million profit. Do the math on that. That is a nearly $360 million positive swing on their bottom line in 1 year. That is not a minor adjustment. It's not a tweak. That is a complete and total reversal of fortune. This right here is one of the most compelling pieces of evidence for the bull case. It suggests a massive fundamental improvement in operational efficiency and financial discipline.
A $360 million swing in a year? That seems way too good to be true. I'm sorry, numbers that big don't just flip overnight because of operational efficiency. That just smells like financial engineering to me. So, was this real, sustainable, operational improvement? Or was there some kind of accounting wizardry at play? Did they sell off a huge asset one time? Something here is not adding up. You just don't go from a $300 million loss to solid profitability that fast without a giant asterisk next to the number. I want to see the asterisk.
You're absolutely right to be skeptical, and guess what? There is an asterisk, but it's not the one you think. In fact, I'd argue it actually makes the bull case even stronger. The key to all of this is understanding a non-cash accounting charge called a goodwill impairment. Let me break it down simply. When Company A buys Company B for, let's say, $1 billion, that value goes on the books as an intangible asset called goodwill. Now, if a few years later, the market decides that acquisition isn't worth $1 billion anymore, the accountants are forced to write down the value. It shows up as a huge loss on the income statement, but, and this is the key part, no actual cash leaves the company's bank account in that moment. And this is the critical piece of the whole puzzle. That $304 million loss back in 2024, it wasn't because the business was imploding operationally. No, it was dominated by a single, one-time, non-cash goodwill impairment charge of a whopping $454.9 million. They had to write down the value of some past acquisition. So here's the kicker. If you pull that one-time accounting charge out of the equation, the company was actually profitable on an operating basis even back then. So the story isn't a miraculous turnaround from a five-alarm fire. It's a company whose underlying profitability was just being masked by a massive non-cash write-down. The 2025 profit isn't some miracle. It's simply a return to the underlying reality. Okay, so we've established a fundamental shift in their revenue composition, and we've demystified that massive swing in profit. But think about this. A house that's undergoing a major renovation needs a rock-solid foundation just to survive the transition. For a company, that foundation is its balance sheet. This is where we check for real financial strength and stability. Does JOYY actually have the resources, the raw materials, to see this ambitious pivot all the way through to the end? It's time to check the books. And here it is. This is the company's ultimate safety net. As of the year at the end, JOYY was sitting on over $3.2 billion in net cash, cash equivalents, and short-term deposits. Let's be very clear. This isn't just a cushion, it's a war chest. This massive pile of cash gives them immense flexibility and a huge margin of safety. It allows them to invest aggressively in their new advertising engine, it allows them to weather any storms in their legacy live streaming business, and it allows them to return capital to shareholders through things like buybacks and dividends, all without taking on a single dollar of debt. In a high-risk transition like this one, having a fortress balance sheet is absolutely non-negotiable. It provides the stability they need to finish the job. And it's not just about money. The raw material for a social media or entertainment company like this is its user base. And here's another critical point. While the live streaming revenue is down, the overall user base is not. Global mobile monthly active users, what we call MAUs, actually grew 3.4% year over year to 272 million people. Now, this is crucial. It shows that people are still flocking to their platforms and their ecosystem, even if the ways they're making money are shifting. This growing user base is the audience for their new advertising business. It's the pool of potential customers. The foundation of users isn't cracking at all. It's actually expanding, which gives them even more ground to build on. Okay. Let's put it all together then, because it all comes back to one thing. I see the cash. It's a huge number, no doubt. I see the users are still showing up. I get it. But the fundamental question remains the same, and it is the single biggest risk to this entire investment thesis. You have a core business, live streaming, that is actively, measurably shrinking. It's the engine that has paid the bills for years. So, is a mountain of cash and a growing pool of users truly enough to build a future on when your primary revenue stream is drying up? It feels like a race against time. They have to build that new advertising business faster than the old live streaming business rusts away into nothing. That is the entire bet, right there. You've nailed it. That is the fundamental tension at the heart of this stock. And that brings us to our final section, the iron verdict. We've stress-tested their turnaround signal, we've deconstructed the revenue, we've solved the profitability puzzle, and we've checked the foundation. So now it is time to weigh all the evidence. We need to look at the bull case and the bear case side by side and deliver a final, actionable conclusion. Is this an opportunity to get in on the ground floor of a successful reconstruction project, or is it just a classic value trap waiting to spring? All right, let's lay it all out on the table. The bull case is definitely compelling. You have explosive advertising growth of over 62%, which is a clear and powerful new engine. You have a verified return to GAAP profitability, which we've now clarified was masked by that one-time impairment charge. You have a massive $3.2 billion cash pile, providing a huge margin of safety, and this is all supported by a user base that is importantly still growing. That's a strong case.
But the bear case is just as clear, and I'd argue just as potent. The core business, live streaming, is shrinking. That's not a forecast, it's a fact. Period. The full-year revenue for the entire company is still in decline, which is a tough pill for any investor to swallow. And all of this puts them smack in the middle of an incredibly difficult and high-risk business transition. There is absolutely no guarantee of success here. They are basically trying to swap out the engine of a plane while it's in midair.
So here it is, the iron verdict. What we're looking at here is a high-stakes reconstruction project. The old foundation, their live streaming business, is undeniably shrinking.
And that is a major risk that you simply cannot ignore or wish away.
I agree. But the new growth engine, advertising, is strong and its growth is actually accelerating. This is not a comfortable set-it-and-forget-it type of investment. An investment in JOYY today is an explicit bet on management's ability to execute this complex remodel. It is a bet that the new construction will outpace the old decay.
And so ultimately, everything we've discussed today comes down to this single, powerful question. They are forging a brand new engine, and all the early signs show that it's powerful. But the old engine that got them to this point is sputtering and failing. So will that new engine be forged, installed, and running at full capacity before the old one completely rusts away and the entire structure fails? The race is officially on, and the answer to that question will define not just JoJo's next chapter, but whether it becomes a story of triumph or just another cautionary tale. For us at Iron Financial, you can bet we'll be watching the pace of that construction very, very closely. Thanks for joining us.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.